The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, folks, this is Larry Pesavento. If you have any questions, 877-927-6648. I'd like to start the show out by sending some white light. Everybody should do that to everybody that's being affected by this particular storm. We were coming through Los Angeles airport yesterday, and believe me, it was a disaster at American Airlines. There were people, the lines were so long, you just couldn't believe it. And, of course, they use this, it's an act of God, and so the insurance, for room and board during the delays does not count, and people were just really, really furious, and it was really not a happy sight, and I can imagine what it was on the East Coast if that was the West Coast, and it'll probably be that way for a few more days. It's affected the whole world because most of it comes through either New York or Hong Kong flights were all canceled, so it was really quite a mess up. How bad it's going to be, we'll have to wait and see. But I'm watching the news like everyone else, and it's really quite scary. But we'll have to wait and see what history repeats. Okay, I wanted to start the show. I had the opportunity in the past couple of weeks while I was gone to review a new book that's going to be coming out. About the works of George Lindsay. Ed Carlson, who is one of the Market Technician Association people who lives in Seattle, is writing a sequel to the book that he originally wrote. And Lindsay was really, I guess he was very important about his 3 peaks and a doomed house. Now the problem with Lindsay, and he was in the 50s and 60s and 70s and 80s in Wall Street. He was originally in New York. He lived not too far from Arch Crawford in Greenwich Village, and then he moved to Los Angeles. I was a regular on. It was called FNN before it was CNBC. Before it was FNN, then moved to New York and became CNBC. And Bill Griffith and Sue Herrera would have me on the show, and he was also a guest of the on TFNN. FNN at that time. The problem with Mr. Lindsay is he had a really eccentric lifestyle, folks. He would come on wearing, pink hats, pink shoes. Just really, he was eccentric. And, I had a chance to go on a show with him once, and I told Bill Griffith, I said I couldn't do it. I said because I couldn't keep a straight face just because of, every day was Halloween for him. So it was difficult. That's why he was not accepted well on Wall Street, but his calls that he made, some of them were absolutely phenomenal. Now, the reason why I'm bringing all this up is that the book that Ed Carlson wrote doesn't cover any of that, baloney stuff that I just talked about, but it talks about the works that the guy did, and he did have some really good ideas. And the chart that I posted into the Tiger TV shows one that came from Bloomberg, where somebody overlaid the patterns that Lindsay looked at when he did this 3 peaks in a doomed house, and it was based on time counts. And he started his time counts in the middle of the cycle, which was very unusual to begin with, but it basically gave him the same count that he needed to fulfill the pattern. And as you can see, what we have going on now is a very, distinct, 3 peaks pattern that we have going on, and whether that's going to be a move down, I don't know. All I can tell you is that, we have this full moon today, which is affecting the storm a great deal. We have some perfect patterns that are completing in the stock index futures. The NASDAQ is completing exactly at the 61% retracement. The S&P on the E-mini S&P contract, which is, trading as we went through to Friday's trading, had a beautiful ABCD pattern up there at 1468 level, and has now come down and stopped almost exactly at the 50% and 382 level of that move. So we're getting some buying patterns here in an oversold market coming into the full moon. Now remember, on the last time we had a full moon, back on October the 4th, we had a situation no, that's not right. Yeah, well, it was October 4th. Yes, is when we had the market was making a top at that time, and now we're making a bottom. All it's doing is it's going back and forth like it does many times with that 28-day cycle, and that's really what we're watching. So we should have strong support at around 1392 in the S&P E-mini that we hit, and it's really good that we're closed today because it gives everybody equal footing, because people that don't trade electronically don't have the same access that we do. And besides, when it's this way with storms and stuff like this, it's very a lot illiquid. There's a lot of illiquidity. Now Forex is different because there's a lot of people in the world that are still trading Forex, and that's trading normally, and so there's nothing wrong with that. But as far as the commodities and the other stuff, I'm really happy that they closed everything, because it makes it fair for most people. And believe me, fairness is what we need in some of these markets now, given the fact that we've had a lot of these bankruptcies and things that have occurred, for so much more. Now, I want to go over a few markets, because I was in Asia for quite a few. I was there for 8 days. I had a seminar and met a whole lot of really nice people, which I really enjoyed. But one of the things that we talked about was we were having a Gartley pattern forming in the Chinese stock market. That's the FXI, which is the ETF for the Chinese market. And we completed a perfect ABCD pattern up at the 618 retracement. And now, if this is correct, we should be starting down. Now, I know what I'm saying here is a little not controversial, but it's a two-sided market, because I'm getting a lot of buy patterns in the S&P and the NASDAQ. I'll show you some of these as we go through the show. I'll post them into Tiger TV. But in the Chinese market, we're getting a negative bias, and it's been a two-way market all along. And so you've got to trade each one of them separately. If I've learned anything in these decades that I've been doing this, is that each one has to be looked at separately, because the people making those decisions, are separate from what we're doing. And this is one advantage of being a technician, even though we have this terrible this storm that we have going on now. It really makes it really, really difficult to be bullish when you have something like this happening, that there's a possibility of that. Now, I wanted to take a second and talk about Apple, because that's basically the NASDAQ follows Apple nearly 100%, and we're making a 61% retracement on Apple from the May low. It's down over $100 a share since it made that big butterfly pattern up at the 705 level. And now we have the 618 here, but we also have a potential for the market to go down all the way to 568, which would be the 786, and it would also be an AB equal CD move. So I wouldn't really be interested in Apple from the long side until we approach the 568 level, and that's when I would look at the possibility. And I've been bearish to stock since 700, but whether it's going to hold 560 or not, we'll have to wait and see. But that's the 786 retracement, coming off the May low, and we want to keep an eye on that as far as as really, really good support, if that is the case. Now, I wanted to mention, because the thing that Basil talked about, his three dollies, and the VIX being one, and bonds, and then of course the S&P, but the VIX index, Basil said if it gets above 20, there's going to have a lot of bearishness to the market, and I see the same thing, because there's a lot of resistance in that area of 20, and if we get through that, that tells us that we've got a potential, for the market to break down. And I'm still very bearish, but for the next few days, and maybe all the way through the election, there might be a real election surprise. I don't know what the surprise would be. It couldn't, the way the politicians are, I don't see how it could be any worse than it already is, but it could be. And if things do change, if they see something that has, changed something totally different, then we'll see if that's the case. Now, in 1980, Reagan was way behind Carter, and I happened to be friends of some really big supporters of Reagan who were very good friends of his, and it got to go to all of the or both of the inaugural balls in in Washington, and when he was elected, the market took it very badly. Of course, the market was going down anyway because we had inflation at 15%, well, around 15%. Interest rates are around 14%, and we had the problem with the Iranian students, hostages and stuff. So it was really really bad time. And yet, in August of 1982, 2 years after the election, we made the biggest bottom that we have made since 1974. That was on August the 9th of 1982. So the cycles that we're looking at is what really are going to be moving this. And but the short-term emotionalism that we could have on the 6th and 7th of November could really be, very, very volatile. It'll probably conform to the numbers. I'm pretty sure that it will, but it'll be very, very volatile during that time, especially this election, because we have so many people in the Senate and in the Congress who need to be replaced on both sides of the houses. It's not just Republican or Democrat. There's both sides need to be shaken up and give them a swift kick in the pants. But I firmly believe they should only be allowed to do one term. This 4 and 5 terms of this stuff is totally baloney. Richard Lugar from Indiana, where I'm from, had been in office for since that was 30 years ago that he was in office. I remember he was the mayor of Indianapolis, and so that's that stuff has to stop because it becomes power. Better get off my soapbox and get back to the markets. Okay, we're going to talk now about we talked about Apple, and I want to show the NASDAQ chart, the daily chart for that, and that shows you that we have the 618 had just been hit on Friday, and the market closed up on the day. It had a pretty big reversal, and so that tells us that I think that's a pretty good bottom. That's why I would have been bullish coming into the market today, for the fact that the S&P hit those major lows. We hit the same thing in the Dow Jones. We hit the same thing in the Russell. All of these have come, together at the same time that we have the full moon, and the last full moon was a high. This full moon appears to be a low, and the ABC formation that we have on the longer-term basis is also, coming into effect. So this is one of there's many reasons, but I do think we're going to get a short-term bounce here. Longer-term, I am very, very bearish, and the reason why I'm bearish, I've talked about this for the last several months, and that is the fact that the divergence in the Dow Jones Transportations versus the Dow Jones Industrial has never been seen before. Historically, I think it's going to mean a great deal. Very few people are paying any attention to it at all, but to me, I think it's very, very important. Richard Russell, the founder of that, is even more adamant about it than I am. And some of my old-time trading buddies are also, very, very staunch supporters of that Dow theory. And the reason for that is if the transportations are not moving, that means the goods aren't moving. And we'll have to, see what history says. Anyway, we have to pay a few bills here for our chairman of the board, Mr. O'Brien.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, folks, we're back. I wanted to go back to the Three Peaks and a Domed House and George Lindsay subject that we were talking about when we started the show. The reason why I brought this up was that the new book that he's brought out goes back with some of the research that Lindsay had done, and what it did was he reconstructed it so that we could see it, a little better, because the charts that he had were, back when we didn't have much for charting. In fact, some of his data goes back to the early 1800s, before the Civil War, and it shows the patterns that were there in the stock market. And folks, if you don't believe in patterns, you ought to get this book just to see the patterns that were there 100 years ago or 200 years ago are still there. They're no different. They might be a little higher in the amplitude. They might be a little lower in the amplitude, but the patterns basically, still there. The market only does three things, up, down, or sideways, and that's basically what it does. And from that, we're looking for where we think we should be a buyer seller. Now, I want to put the reason to buy the book, and it's not out yet. I'll let you folks know when it comes out. Is that the historical things that he has in there are really terrific. I mean, the dates that are there, the time counts, and how he did it are there, and the patterns of all the different things, and he's got them on weeklies and monthlies. So the data itself is worth the price of the book, and then the theory, I think, is still pretty good because it's based on structures of cycles and stuff, and that's why I think it's pretty good stuff to look at. Okay, the next chart that I want to put in Tiger TV is the one that I mentioned earlier, and that is this long-term weekly chart of the cash S&P, and it shows the tops that we made in 2010, 2011, and what we had so far in 2012. And you'll notice that we made a perfect AB equals CD pattern last week, coming off our May low that we had, back on May the 4th or 5th. Actually, might have been the 2nd. And then, of course, we topped in, October, and we've been down for 4 or 5 weeks, and we stopped at the 382. That tells with that ABCD stopping exactly at the 382 and the NASDAQ stopping at the 618. It is just really, you got to pay attention to this number, folks, because it really means something. Now, the reason why this chart is important is not because of what's happening now. It's because of what happened in 2011. If you'll see in 2011, we came down for about 6 weeks, and then we had a really strong 3 weeks up into around the 1st of July. And from that, we just came, totally unglued. And this is what I think we might get this time. We might even get a move into new high ground, which is certainly possible. But I do believe we got a shot for one really strong rally and then a big move down. The other thing is that the storm could be so bad that, it's going to take a 0.5% or 1% out of GDP. And, then the market will, start down and, might not look back. But as long as we're holding above 1390, in that S&P, that looks like it does have pretty strong support. But below, I would say 1385, I would say, this thing is still going to go a lot lower. So long term, I'm very bearish, mainly because of the longer term patterns, of course, but then the transportation index being so, underperforming the rest of the market. Because if they're not moving the goods, and believe me, these transportation stocks have really been hit hard. And if you look at the transportation index, and I will put this chart up a little later in the show into Tiger TV, and you'll see the difference between the transportations and the Dow. That's historically, we've never seen this before. And we've never seen what's happening with the Federal Reserve and QE1 and QE2 and QE3. These are experimental. There's no other way to look at it, folks. I mean, what Bernanke is doing, and he's a college professor from Princeton, and he knows quite a bit. But, sometimes, what he does could be, not what the market thinks it is. And then that's when the real problem is how do they wind down from this thing. This is what happened with long-term capital. They had all the Nobel Prize-winning economists on their board of directors, yet they still went, tapioca because they forgot to consider what could happen when liquidity dries up. And that's what happened with the Russian crisis. And they had to go to the Fed, and the Fed finally had to buy them for, 10 cents on the dollar or whatever it was. And then, from then that was history. So, these things are historical, so you don't know what is going to happen. And what the news people don't tell you is the fact that these things are experimental, and we don't know what's going to happen. We never know what's going to happen next anyway, but these are really experimental. And they're doing the same thing in Europe, with Mario Draghi is doing the same type of thing with these unlimited open-end, buying of bonds. But eventually, in a credit cycle, you're going to run into problems because someone's going to let the credit dry up. Okay, we're going to take a break here. We're at the halfway point, 877-927-6648.
You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to check out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday, Wednesday, and Friday, 11 a.m. Eastern on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Philadelphia. Hi, John.
Welcome back.
Well, thank you. How's the water there?
The water is coming down at an inch an hour, and Philadelphia is seeing that rate on and off since noontime yesterday. So,
wow.
Noah, get out his ark.
Yeah, that's what I was watching my grandson on the webcam a little while ago, and I could see the rain, pummeling the glass window. So, what can I do for you, my friend?
Larry, I cannot help but recall October 3rd, a Wednesday. While doing your show, you gave us a teaser, and you definitely teased me. The teaser was this. You said, folks, you've got a friend of decades, a fellow in the UK, a fellow who does cycle work of his own making.
Yes.
And you said, by the way, folks, his work has been accurately forecasting a rally, and his cycle work was calling for a rally peak, a cycle high.
On October 5th, yes.
October 5th. Now,
yep.
The Dow Jones has made its rally high that day, October 5th, at 13,661. My question to you is two things. One, can you update us as to what that work is saying now? And two, more importantly, did he give you his permission for you to share with us the methods behind it?
The answer to the second question is he asked to be remain anonymous, and also that I not share it. So I certainly will respect that. But it is unique, I can tell you that, and it is based on just strictly numbers. Has nothing to do with astrology. It's more to do with geometry. And the first part of it is he believes that the next, after this October 5th date that he looked at, he's looking at November the 2nd, which is, I believe, this Friday. And is it the Friday? Yeah, November 2nd will be important. But then, we've got the election coming in, so that could affect it a little bit just because of the volatility of people getting emotionally attached to whoever wins, But
sure.
He really feels strongly that the market is heading down, and his first target on the S&P is 1140, I believe, is what he's looking at for the downside.
Well, I thank you for that update. I can't help but think myself, Larry, as well. The Bradley model, as far as the S&P, since August 1st, has been not good.
Yes,
but
that's correct.
It was absolutely precise from January 1 in through August 1. And there is that sticks out like a sore thumb, that major low, like the last day of the year here. So I can't help but at least remind myself that exists.
Well, the most amazing part of this, John, is, I've known him for quite a while, and he started showing me this in May. And, of course, in June, after the market had rallied up and made a new high, I believe, that's when he gave me and his prediction on the price was 1450.
Yeah.
And, of course, we went a little bit higher than that, but, the date that he had was, October the 5th, and he gave me that date, a long time ahead of time. So, you have to respect anybody that can do that. And so we'll just have to wait and see. But, he said I'm more than willing to share the information, just not the methodology that he has.
I thank you for sharing the output anyway. Yeah. So thank you, and thanks to him as well.
Yeah, someone asked me, John, when would this target of 1140 be achieved? And I have that date here that you can write it down. I'm just joking. I don't have the date. I wish I did. But if I do get the date, I'll certainly put it. Maybe it'd be a good time to buy a put or something.
Yeah, maybe I'll.
If I knew that, I'd have to kill you, John.
maybe I'll create some S&P 1140 puts and sell those short, collect the premium.
Okay, buddy. Nice
Larry,
talking to you, my friend. Yep. We got a call from Ed in Florida. Are you there, Ed?
Yes, I am.
What can I do for you, my friend?
Okay, this is what I'm looking at. When I'm looking at the U.S. dollar index future, I'm looking at the on the Thinkorswim platform.
Sure.
And I'm looking at the daily, and I have my chart next to it, which is the euro dollar. Okay,
yeah.
And basically we're looking at an inverse, chart. In other words,
That's correct. They will be the opposite.
Right. But here's my question. So I'm looking at the dollar now, and it looks like it broke above the last, say, 20-day support, just a little bit above, okay? Now, the euro, it hasn't broken down its support, even though it looks like it's going down. So if you look at the two charts, they're, close. But so right now when I'm looking at it, is it the dollar that is strong, or the euro is not as weak? In other words, who would win this? If we're looking at the charts, which one will look like it's maybe affecting the other? Who's got the lead in this race?
Well, if you had to bet on a horse, I would pick the euro, and the reason why it's the most actively traded liquid thing in the world by far. Nothing even comes close. And so that's the one where the real money is flowing. With the dollar index, even though people look at it, not many people trade it. And it's 53% weighted with the euro anyway. And then you have the other cross rates that are in there. So the lead horse here, the secretariat of the two groups, of course, is the euro. So watch that. If the euro goes below that 128.50 level, then that would tell us that, it's getting ready to break down. The dollar's getting ready to, to head back up again. And so that's why I would look at the euro, only because of the liquidity is so huge and so many people trade it, and very few people, trade the dollar index. I trade a lot, Ed, and I haven't traded the dollar index more than a half a dozen times in the whole year. So that ought to give you an idea of, what we're looking at.
And usually the euro kind of goes most of the time with the market. Of course, now it does detach every now and then. I've noticed.
Sure.
So is there anything looking at then? Is there another chart that would look when I'm looking at the euro that would possibly lead me to believe that the euro is weakening against something, and it looks like it will turn.
Yeah. You can do spread charts, where you can take the difference between the two and put the spread up, but frankly, I don't do that. All I do is I look at each entity separately, because I base my trading decision on how much I'm going to risk, not whether I'm going to be right or wrong or not. And so, that's why I only look at each one of them separately. But I've looked at those correlations, Ed, to try to find, some type of a lead, and other people have too, but I haven't found it. So I just look at each separately, and I get by just fine with that, and that's really what I end up. I try to keep it as really simple as possible.
Right. Ultimately, in other words, when it's approaching a support line or a reverse signal, a line in the sand somewhere on the chart.
That's the word, line in the sand. Where people put their own skin in the game, and then that's where they're really playing, and that's where the euro really is the place to watch, because that's real money. All the time, really moving. The dollar index, the volume of the two is insignificant compared to what the euro does.
Mm-hmm. Now, the euro versus the like say the ES, does one lead the other? I mean, because they're also
don't know the answer to that, and I don't think anybody does either, because sometimes one will lead, sometimes the other one will lead. I don't know what the answer is.
Right.
I just wait till the pattern completes, and, if it's right, I do it. If it's wrong, I take a loss, and that's, the bottom line.
That's right. Okay, well, that sounds great. Because
I'm sorry to be vague, Ed, but I don't know the answer. And if you want me to lie to you, I can do that, too, but I prefer just to say I don't know.
No, this is good, because that means that it's not like something that I'm missing that's so obvious then.
No, you're not missing anything. Believe me, people have looked at this ever since they started, trading the E-mini S&P. Of course, Forex has been around for quite a while, but it's basically a lot of money moving with euro, and that's why it's it's so fun to trade. Is that everybody has an opinion every 15 minutes, and it goes up and down with great regularity that makes it a great trading market.
I caught you just a little bit late on the full moon that's coming in today.
Yes.
Does this look like the market will?
This looks like a bottom to me in the market. It really does. I mean, it hit all the ABCD patterns on the weekly S&P, 618 on the NASDAQ, 382 in the Dow Jones Industrials, 382 on the weekly S&P, and 618 on the ES on the hourly chart. So all this tells me that that we're getting ready to bounce coming in today. Now, whether this storm will affect it or not, we'll have to wait and see. We might be closed for a couple of days if this thing gets worse. So,
right, exactly. On the time frames that you use on charting, is there a particular one that you put a little bit more weight to, like either an hourly or a half hour, or do you go anything less than a half hour?
Well, actually, for pattern recognition, I like 30-minute and 60-minute, but for trading purposes, just to take money out of the market, if you'll look at the 15-minute euro and the 15-minute bond and 15-minute gold and 15-minute crude oil, you'll get tremendous patterns that are there that'll give you low-risk opportunities and high profit. We had one that I posted into Tiger TV just a little while ago on crude oil, and it's dropped almost $2 a barrel in a market that's not really trading very much today. It's been the most volatile. And that was just a small pattern that occurred that, just keeping myself busy. I was watching. I didn't even do the trade, but, someone was asking me what to do, and I said, well, if you're going to do anything, look at this. And, it happened to work out nicely, but it's just a pattern. That's all it was. It's only a probability, never any certainty.
I'm looking at the YM, and I guess even the ES. Did it complete a pattern at 7:30 in the morning?
Well, it actually did. The pattern completion on the YM was actually on Friday. That completed on Friday about mid-morning, as I'm showing here, looking at my screen. But and so that was when the S&P was down around 1392. So yes, it did complete, but that was on Friday. But the full moon comes in on come in late last night and early this morning. So that's in the realm of where it should bottom, and then it usually lasts anywhere from 5 to 6 days. And if that's correct, we should get a 5 or 6 day rally because we're basically oversold, and we'll go from there. Actually, considering the market and all the news with the storm, it's not down very much. Really isn't.
Right. No. Yeah. Right. Exactly. Well, fantastic, Larry. Hey, you set some things straight with me. I really appreciate your time, and we all do. All us guys that listen to you, we enjoy your insight, and you're doing a great job.
I mean, both of you do. That's good. I like that. Yeah. Okay. Thanks a lot.
I'm going to have my mom send you an email, too,
Okay. Thanks a lot. Okay, the next thing we want to look at, folks, is we want to take a look at the Treasury notes and Treasury bonds. And I'll start out with the notes because it really depicts, where we are. We had a low back in April. Then we made the new highs with that butterfly top in that 135, which was the equivalent to 154 in the Treasury bonds. And then what's happened is, and it's very interesting, is because we've gone from July the 28th to where we are now, we've basically done nothing but make a slight retracement at the 50% level. We've made an ABCD pattern just last week, and now the rates have started to drop again. So there's a chance here that we could have one more run-up into the lower rates for a while, especially if the stock market backs off, and they might do the exact opposite again. In other words, rates drop and stocks drop. So we have to formulate that as one of the strategies that we're looking at. Now, when we look at the Treasury bonds, we're going to go to a little bit shorter time frame here, and you'll see that it made a really nice Gartley bottom on Friday. That was actually on Thursday, down at the 146 level. That was an ABCD at the 786 level, and now we've had a pretty strong rally for a couple of days here, and there's a potential for the 152 level to be hit. And if we get above that, then we could be heading into even higher ground. But the notes are the ones that I'm watching because that's the shorter term paper. That's just the 235 area in I can't think of the word for expiration. Anyway, that's what their contract expiration is. That they last from anywhere from 2 to 5 years, and so that short-term paper is very important because they move a lot of that quickly, especially when there's times of people not understanding what they're doing, like we're having now. We don't have a runaway consensus in anything, mainly because of the the election and the QE3, and the whole all the other stuff that's there. So we want to watch these notes and bonds, really carefully on what this rally is happening here, and that's something that I think is really important to look at. Now I need to cover the gold and gold and silver because we have the same type of scenario happening in gold and silver. We're going to cover that right after we come from our break here. And then we will finish up the show with the gold and silver and also copper.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
And I put into Tiger TV what I think is a really important chart. I think it's probably one of the more important ones of the week, maybe the month, I don't know. But we've had this big run-up in gold, the ABCD. We stopped exactly where we should have. At the ABCD point at 1797. And now what we've done is we've been on for about 3 weeks, and we've stopped exactly at the 382 retracement at 1696 to 1694. And as long as we don't go below that point, you just put 1690 on your charts. As long as you hold above 1690, and this thing starts to move higher, we got a shot at some big prices. Way over $2,000, because we had a heck of a move in that gold. You know, we were watching those bottoms all the way from June. We saw the first one in early July. That was the Gartley at 786 that happened at the 1565 level. And we had another one at 1565, and we had another one at 1585, and then another one at 1605. All of them were higher bottoms all the way up, every single one of them. And then when we reached that ABCD, we had our first correction, and we came down to the 382. Now, 382 is, one of the Fibonacci numbers. It's the one that if the market is really bullish, it's not going to break below that. So as long as gold can hold above 1690, it's got a potential to be, very, very bullish. Now, at the same time, we have the same situation occurring in the silver market, because we did the same thing in silver that we did in the gold market. And that is the fact that we came down to the 382 level. Just a second here, and if I can get the right chart up here, we'll get it there. So can't do two things at once anymore. Oh, I guess I didn't do it right. Sorry, folks. There it is. Finally got it. 1 out of 3. We did the same thing in the silver market. We went a couple pennies below it, but that $32 per ounce level in the silver was the 382 level, and we have held above that also. Now, silver is much thinner than gold. It's about 1/5 the volatility and volume of the gold, so that's one of the reasons why you'll see a little bit of slippage sometimes in the numbers. So that's it's also important that we watch that. Now, the one that's happening now that is very important because we're breaking below it as we speak, and that is the 61% retracement in the crude oil came in at the 85, 90, 86 level, and crude oil today has broken down $1 a barrel, under that. And this is what I put in the newsletter was that if the market gaps down when we open, on Monday or Tuesday, or Tuesday, I guess now, that will negate, the buy in the crude oil because it'll go all the way down to the 82 level, which will be the, the 786 level. So that's the first one that looks like it's starting. Well, it's not looks like it is starting to break down and head towards the 786. This is why it's really important to listen to the numbers from a technical point of view. If you like patterns, 1390 in the E-mini S&P. As long as we stay above that, the market has a pretty good bias because of the ABCD. The retracement's taken 3 weeks to get there. And also we have a full moon now, and the last time we had a high, we were on a full moon, so we have a low on a full moon. That would be a mirror image. We have a 61% retracement in the NASDAQ as of Friday's low, and we have also a 382 in the Dow Jones. And so a lot of these things are telling us that we're at that point. So that's 1390 in the S&P. We're looking at 1690 in gold for that to hold up. Crude oil is already broken below 86. It's trading below 85 right now. So that's telling us that that is already, starting to, go a little bit lower. We've got to end the show. May God bless and make everybody happy as best you can and live every day with an attitude of gratitude, my friends, because time is short.